Gold prices have surged to record levels in recent days, drawing widespread attention from investors around the world and reshaping discussions across global financial markets. The rise has been driven by a combination of political uncertainty, shifting investment strategies, and strong demand from both institutional and individual buyers. At the same time, recent developments have triggered a sharp pullback, highlighting both the appeal and the volatility of precious metals. This report examines the key reasons behind the historic rise in gold prices, as well as the factor that has recently contributed to their decline, based solely on the facts presented in the article. Earlier this week, gold crossed a major milestone, climbing above $5,000 per ounce, or 3,646 pounds, for the first time. On Monday, prices briefly surged even higher, touching $5,500 per ounce before retreating. Silver and platinum followed a similar trajectory, recording strong gains alongside gold. Although prices for all three metals have since fallen sharply, they remain significantly higher than at the same point last year. The movements underscore how sensitive precious metal markets are to political signals, investor sentiment, and broader economic conditions. The recent rally in gold has largely been fueled by its reputation as a safe haven asset during periods of uncertainty. Investors often turn to gold when concerns rise about political stability, economic growth, or the value of major currencies. In the current environment, global political developments have unsettled markets, prompting increased demand for assets seen as stable stores of value. As money flowed into gold, prices accelerated rapidly, pushing the metal to levels never seen before. One of the central drivers of this uncertainty has been trade policy in the United States. Tariffs introduced by U.S. President Donald Trump on countries seeking to trade with the United States have disrupted global commerce and added to investor unease. These tariffs have been targeted at countries the president views as unfavorable trading partners, and their impact has extended well beyond bilateral trade relationships. According to Emma Wall, chief investment strategist at Hargreaves Lansdown, these policies have continued to worry investors and have played a significant role in driving the rally in gold prices. Earlier this year in January, both gold and silver reached record highs at a time when share prices were falling. That market reaction followed threats from President Trump to introduce fresh tariffs on 8 European countries. These countries were opposed to his proposed takeover of Greenland, and the resulting tensions weighed heavily on equity markets. As investors moved away from shares, many turned toward precious metals, reinforcing gold's role as a perceived refuge during times of political friction. Economists have also pointed to broader concerns about U.S. foreign and fiscal policy as a factor lifting gold prices. Hamad Hussein, an economist at Capital Economics, noted that gold has increasingly been viewed as a safe investment when contrasted with the risks associated with U.S. policy decisions under President Trump. This perception, he said, has placed the precious metal firmly in the spotlight, attracting attention from a wide range of market participants seeking stability amid uncertainty. Beyond private investors, central banks have played a major role in pushing gold prices higher. Central bank purchases of gold have been a key factor supporting demand and lifting prices. Emma Wall explained that both investors and global central banks have increasingly favored gold as their reserve currency of choice. According to her, this preference reflects a belief that gold can insulate holders from dependence on U.S. policy decisions and from fluctuations linked to the U.S. dollar. Wall also highlighted how recent global events have influenced these decisions. She said certain nations may have observed the threat of Russia having its U.S. dollar assets seized by global players supportive of Ukraine. In response, those nations may have reassessed the risks of holding reserves tied to specific currencies and considered gold to be a more attractive and neutral reserve asset. This shift in thinking has contributed to sustained demand for gold from official institutions. However, while central banks continue to buy more gold than they did before 2022, the pace of that demand has shown signs of easing. According to Hamad Hussein, estimates suggest that central bank demand for gold softened in 2025. Even so, buying levels remain elevated compared with earlier years, continuing to support prices at historically high levels. Demand for gold has also been driven by a diverse group of buyers beyond central banks. China stands out as the world's largest buyer of gold, with demand coming from both individual consumers and investors. In China, individuals purchase gold in the form of jewelry, while investors buy it as a financial asset. This combination of cultural tradition and investment demand has made China a major force in the global gold market. In Western countries, investors have also been significant buyers of gold. Large amounts of money have flowed into publicly listed companies that own, mine, and trade gold. These investments provide exposure to the metal without requiring direct physical ownership, and they have attracted interest from those seeking to benefit from rising prices while diversifying their portfolios. In addition to traditional buyers, new participants have entered the market in recent years, further intensifying demand. Hamad Hussein said new buyers have been picking up large quantities of gold, contributing to its dramatic rise. One example cited in the article is Tether, a digital currency specialist. The company has reportedly purchased so much gold that its reserves now exceed those of some small countries, underscoring the scale of demand coming from unexpected corners of the financial system. Despite the strong upward momentum, gold prices have not moved in a straight line. In recent days, prices began to fall sharply following signs of political stability in the United States. One key factor behind the earlier surge had been fears that President Trump might choose a Federal Reserve chairman who would comply with his demands to cut interest rates. Such a move was seen as potentially weakening the U.S. dollar and pushing inflation higher, conditions under which gold is often viewed as a protective asset. Those fears eased when reports emerged that the president would nominate Kevin Warsh as the next Federal Reserve chairman. Warsh is seen by markets as a relatively safe option compared with other potential candidates. Following those reports, gold, silver, and platinum prices all declined sharply, reflecting a rapid shift in investor expectations. Even after the recent drop, precious metal prices remain well above levels seen a year ago. Ongoing geopolitical tensions, existing tariffs, further tariff threats from President Trump, and conflicts around the world continue to influence investor behavior. As a result, gold and silver still appear attractive to those seeking safe haven assets in an uncertain global environment. Another enduring appeal of gold lies in its relative scarcity and its unique position among financial assets. Nicholas Frappel, global head of institutional markets at ABC Refinery, told the BBC that owning gold differs fundamentally from holding bonds or equities. He explained that gold is not tied to the debt of another party, nor is its performance driven by the success or failure of a specific company. For many investors, this makes gold a valuable diversifier during periods of uncertainty. At the same time, recent price movements have highlighted the risks involved. The volatility seen on Friday demonstrated that gold's value can fall almost as quickly as it rises, much like other traded commodities. These fluctuations serve as a reminder that while gold is often viewed as a safe haven, it is still subject to market forces and sudden changes in sentiment.